We have next question from Ashish, and he writes that I have both direct shares and equity mutual funds in my portfolio with a long-term vision. Is it fine, or am I just duplicating efforts?
You are not duplicating effort. If you're trying your hand, I think be methodical about it. The only thing you should worry about is these are different ways of achieving the same results. You can invest in stocks directly. You can invest, if I go from assuming that there are investors who have to invest in equity for the next 5 years and more, then there are different paths to investing for 5 years and long-term investment. The easiest and the first step should be investing in a hybrid equity fund, 75% equity, 25% debt, and a conservative hybrid equity. The equity portfolio is managed conservative, so you get used to it and you are able to onboard or step into equity without much of a heartburn. Then comes investing in large cap fund, which is a step ahead, all equity portfolio. Then diversifying more, invest in multi caps and large and mid cap fund. Then investing in the small caps and mid caps, which could be aggressive way of investing in companies which are small, which can potentially go up substantially, and they will also be extremely volatile. Volatility is not risk. Volatility is scary, and of course, the risk of the underlying companies, whether they can withstand a downturn, whether they are well managed, whether they can scale up, those standard business risks actually prevail. And then comes investing in stocks directly, where you are taking a call. So if you have the time and if you have the interest, it is a good way, but be methodical about it. Maybe just have 25% of your money, try it out for 3 years. The big advantage of investing directly in stock is that if you are enjoying it and you have all the principles, you are learning on the way. If you can diversify well, choose good companies, invest, and you have the temperament, I think these are critical elements. If you don't have this, if you don't have time, if you don't have interest, and if you are not enjoying it, if you don't have an investing temperament, choosing a company and holding it and withstanding ups and downs, then go for a mutual fund. Mutual fund provides you all kind of, and then it's a matter of scale. You should be doing all this only if you have something meaningful there. For your 2,500 rupee, it is very hard to do all that and make sense of it. And so if you are able to do all that, you will also save the expense ratio. You will also save the management fee which you incur when investing in a mutual fund. But if you have 5,000, 10,000, 50,000, and if you don't have the time, if you don't have the inclination, go with a mutual fund. They offer you substantial benefit of doing all this without much to worry about. Yes, you are duplicating effort, but it is worth attempting. I don't think they are different way. They are completely different. You are meeting the same goal more efficiently, but you should have those variables to be investing directly.
While answering this question, you mentioned, and it has kind of stayed in my mind, about volatility, that one should not be scared of it. Yep. More people are. I mean, most of us are scared of volatility. But you just mentioned that it is one should not be scared of it. It's not a risk.
Volatility is a risk if you don't have time on your side.
Okay.
Volatility is a risk if you don't know what you're doing, what you're into. If I'm in a company and because the market is a very mad place, variety of reasons influence the market in a short term, in a very dramatic way. Right. You come across a news item, something happening in North Korea, and the market tanks by 5%.
Sentiments play
a role. That doesn't mean that but if you are an investor, then you are investing or you are becoming the part owner of a company where a lot of people get up in the morning to do an activity, and end of the day they make profits. And that profit, because companies make profit, markets don't. Right. And if companies make profit, the belief is that it will reflect in the stock prices. If it will reflect in the stock prices, it may not happen tomorrow. Right. It may take time, and market will take its own time to recognize that. Given this context, that is the belief, that is the promise of equity. Hold it for the long term. Companies don't disappear. There will be all kind of noise which will be distracting, and stick to it. So this temporary ups and downs. Yes, if you choose a bad stock, or if you choose a fund which has a good track record of picking not so great stocks, then there is a risk. It will be choosing companies where it will be investing in companies which may not do well.
Right.
It may be a speculative fund, or your equity portfolio can be one such. So risk comes from not knowing what you're doing, if you are investing in good companies which will make profit and will not, and that is not an easy thing. You have to do a lot of groundwork, a lot of hard work to figure it out, build your belief system, not get unnerved by a 10% decline in a brief period of time. It's not easy, but it can be done.
Time, as you said, time is important.